Thank you. So good afternoon, everyone. I am David Dietze. I will be joined by my colleague, Fritz Schoenhut. We are delighted to have this webinar this afternoon. It's a very timely topic as we're less than 100 days now from the next elections, November 4th, 2020. So it's on top of everyone's mind exactly what this means for their portfolios and for the economy. And we're going to do a dive on that and try and give you some advice. Now, a couple things. One is we do have a Q&A button at the bottom. We're looking forward to addressing exactly what you want to know on this topic. So during the course of the presentation, if a question moves you, write it in, type it in. We will get it. We will address it at the end. We will also be able to share with you the slides after this. Without further ado, oh, and one other thing, we do have a poll. Polls are always kind of fun. It's a poll that you would very much think of. Who is going to win that big election coming up in November? So we want you to cast your ballot during the course of our presentation. We will share with you the results at the end. So before I get into the heart of the presentation, a word about Fritz Schoenhut, my colleague. We are so lucky at Point View to have him, a graduate of Notre Dame. No, he didn't play football, but he is quite an athlete from what I hear. Master's in taxation and nearly 6 years experience in at Goldman Sachs, working with some very high net worth clients and working on portfolios and so forth. He joined Point View last year. We are so excited to have him here. So I'm going to get started here, but I'm going to give you just a little bit more information on our firm. I'm going to start the sharing here. Do we have the sharing going, Fritz? Oh, hold on. We got it?
Yep.
Okay, so who are we? Who is Point View? Point View, we're located here in beautiful downtown Summit, New Jersey. We are a registered investment advisor. We adhere to the highest fiduciary standards. Our big news as of August 31, after 27 years being totally independent, we are now part of PPAC Private Wealth Management. We couldn't be happier about that because they're managing over $7 billion just down the road in Gladstone, Morristown, PPAC, New Jersey. Great colleagues. We're doing our thing, but we have all these resources because there's a fantastic group of investment professionals out there. Plus, they have other banking products, including things to address the liability side of your potential balance sheet and a great trust operation if that should ever be necessary. Anyway, so what do we do exactly? We provide customized investment management services and holistic financial planning. In short, we want to be you, your family, your small institution's own CFO. Handle it all, be the first call for any kind of financial matter. Tax efficiency is very important to us. Transparency, we part company from some of the competition because we believe it is important to go directly to stocks and bonds and not just hang out in ETFs and funds. $500,000 relationship minimum, 1% annual fee. And what's nice is by going directly to individual stocks and bonds, you do that end run around the underlying fees of funds. We also can do a standalone financial planning package, flat fee of $7,000. Should you take the next step and have us manage all or a portion of your assets, that financial planning fee credited every single dollar you paid, credited against ongoing investment management fees. And just as importantly, your money is safe because it's custodied in your name at Fidelity Investments, one of the most prestigious financial institutions in the world. We've been successful with what we've done. We've been recognized by CNBC, Investopedia, Financial Advisor magazine, and various other sources. But let's now, without further ado, get to the meat of the presentation. So, as we came into this year, it was kind of the common wisdom that with the lowest unemployment in 50 years, with a positive GDP, with progress being made on the tariff negotiations with China, with markets at all-time highs, well, the incumbent, President Trump, was going to get a second term. And indeed, that historically is how it's worked. And if you look at the chart on the left, you can see that the green represents incumbents in the post-World War II era who lost and what their unemployment rate that they were bringing into the election. You can see over 7%, while those who won had much lower unemployment rates. So the strength of the economy, the plentifulness of jobs, very critical. It looked like it was Trump's to lose. And then, of course, what happened? COVID-19. And the whole global economy went into shutdown. We now have the highest jobless rate since the 1930s. We just learned this morning that our GDP is down over 30% on an annualized basis. That's the worst in the post-World War II era. So we went from one of the best economic situations to arguably the worst situation since World War II. We're back into tit for tat with China. Worried about Hong Kong, Huawei, one of the chip distributors that has significant Chinese backing. We have seen, of course, a significant rebound in the stock market since March 23rd, what appears to be the low. But, just looking at the market averages is a little bit misleading because most of the market averages are capitalization weighted and really propelled by some of those very big mega cap techs, while the average stock is still underwater year to date. So based on what the perceived historical wisdom is, it now looks somewhat less than likely that Mr. Trump is going to get a second term and Mr. Biden looks well positioned. So now, of course, it comes to investors, comes to us advising our clients. What does that mean for your portfolio should Mr. Biden lead the Democratic Party to the presidency? But it can get more complex than that because what we have now, of course, is we have a Dem-held House of Representatives, Republican-controlled Senate. Of course, Mr. Trump is in the White House. There is a chance that, and it's almost a 50-50 chance that, in fact, the Senate could flip and become Democratic-controlled. And assuming the House stays the same, you're going to have the same party controlling all three bodies there, including the presidency. So, that's what could happen come November 4th. So the question is, what are you going to do? To be honest with you, if you look at what some of the most successful investors in the world have done, they have basically went and just started reviewing fundamentals of their individual portfolios and not worry too much about what the government, how it was composed. We have a great quote here by Warren Buffett, who says, heck, in the 14 presidential administrations that he's been investing in, there's been half were Republican, half were Dems, and he bought stock through each of them. And as you can tell from this chart, it's pretty much a upward line. The best performer, small stocks, not the big mega caps that we're seeing lead the market today, but small stocks have been the long-term outperformers. Your light blue line is your large stocks, and then your lesser performing would be bonds and short-term treasury bills. So the market has done well no matter who's been in the White House, but hasn't actually done quite as well in every composition. It's not like we've had hundreds of situations to analyze, but actually the best performing composition for the stock market has been a Dem president with at least one of the branches of Congress being from the opposition party. And you can see there, on average, the S&P 500 per year has returned 16% in that configuration. So although the knee-jerk reaction from many out there and many on Wall Street is, the Dems are big spenders, Republicans are fiscally conservative, the Dems want to regulate everything, the Republicans are more laissez-faire, and therefore the market's going to do better than under the Republicans. The fact of the matter is, if you look at the actual record, that just hasn't worked out that way. In fact, even with the Democrats controlling both the presidency and both houses of Congress, they've still done pretty well. In fact, better than where a Republican has been in the White House. So, if you take away one thing from this session here is don't just nod your head to the perceived wisdom that if you don't have a Republican in there, you might as well put your money under the mattress. And also, I think the other takeaway you're going to have here is to not try and rejigger and get too cute with your portfolio in terms of playing the outcome. We like to say that smart investors diversify broadly, hedge potential risks, and stay the course, while foolish investors get all excited as to who they think either will or should win the White House and then push the portfolio in that direction. And that, we think, is a mistake. This slide right here gives you a sense as to which presidents had the best record in terms of the return on the S&P 500. Right there at the top, Bill Clinton. Now, as Jeremy Siegel, the renowned finance professor from the University of Pennsylvania, says, just because the market did better under certain presidents, does that necessarily mean that they caused the outperformance? They could have, it was a correlation, it was a coincidence as opposed to a causation. And point of fact, he is quick to point out that what really drives the market and the economy is these underlying business cycles. And, just consider, are you going to take a vacation, go out for dinner with your spouse because someone's in the White House or not? Unlikely. And so I think the economy works kind of the same, but you can see here the historical record of the presidents. So, what is the Joe Biden platform? So we know what he wants to do. Now, remember, there's a lot of aspects. The three key aspects is, one is, what does the candidate want to do? What is he likely to do when he gets in office? And finally, even if you're sure of all that, to what extent have other investors already placed their bets and so arbitraged away? So, for example, if a presidential candidate is out to take the legs out of a particular sector, and the sector's already sold off because all the investors think that candidate's going to win, there may be no further upside by shorting that sector or going long if they think it's going to be positively affected. Anyway, I think the key thing from an investing point of view is Joe Biden's discussion to roll back at least halfway the corporate tax hike. What was to raise corporate taxes? Now remember, President Trump, one of his signature legislation is reduce the tax rate on U.S. corporations from 35% to 21%. Joe Biden says if elected, he's going to take it back from 21 back up to 28. So quite frankly, that could shave up to 10% off the earnings of the S&P 500. All things being equal, that could at least take the market down 10%. So that's probably, from an investor's point of view, the most worrisome concern. Query whether it's already discounted. And of course, the other thing to keep in mind is, given the recessionary conditions we're in now, still without a proven vaccine, and given the Federal Reserve is doing everything possible to push the economy, and fellow Dem Nancy Pelosi and others trying to stimulate the economy, would a new Democratic president want to, in effect, put a wet blanket on the economy and the market by raising taxes, which would be antithetical to stimulus? Unlikely. There's some positives that I think a President Biden might do. One is to kind of reduce the angst between China and the United States. We still have some tariffs in place, although the best intentions may have been the cause of those tariffs. They feel he's more likely to relax tensions, roll back tariffs. That actually could be a positive for many industries. Infrastructure spending. Historically, the Democrats have been more willing to spend money, and heaven knows, especially driving around the roads in New Jersey, we could use a fresh layer of pavement on our roads. And of course, many bridges and tunnels need fixing up or building. And of course, there's digital infrastructure spending that could happen to make sure everyone in the country has good Wi-Fi access and digital equipment. Possibly, there could be, some people feel, a faster rebound from the COVID virus if perhaps there was stronger, more consistent leadership at the top on that issue. Mr. Biden has also talked about raising the minimum wage. When I went to studied economics in school, a lot of people said that was not good because people, if you raise wages, there's less people that can be employed, and that leaves some people off the table. But some economists have argued that actually could help the stock market and the economy, because a lot of people would have more money in their pockets, and that would help spending, which would help retailers. And of course, remember, no matter what people say they're going to do if they get elected, at the end of the day, right after the November elections, there's going to be the focus on the midterms. And if we are right that the strength of the economy dictates the outcome, at the end of the day, a President Biden would certainly want to do things that would strengthen the economy, which ultimately we believe would help the stock market. So at this point, I'm going to turn the floor over, as it were, to Fritz to take it away and talk a little bit more here.
Sure. Thank you very much, David. And so at this point, we'd like to kind of think about, what should an investor do? And with so many potential outcomes and so many variables heading into the election, it's not just about, who is going to win the presidency, but also, what's Congress going to look like? And, even within the parties, there are various factions that, are kind of jockeying for position or control. With so many different variables and outcomes, in our view and in our recommendation, investors should continue to focus on the long term and acknowledge the cyclical nature of politics. Every 4 years we have an election, and within that, every 2 years, there's the potential to really, change or shake up the makeup of Congress, of Senate, and the House of Representatives. So, rather than trying to plan around a singular election, focus long term has shown to be beneficial. It's also important to consider, what hasn't already been anticipated by investors in the current pricing in the market, and which sectors could be primed for volatility. And with that, it leads us into a couple of different sectors that we've been focused on or are focused on. Next. So energy stocks. So it's commonly believed that the energy industry will be hit hardest by a Biden win. Democrats have really been pounding the table on the fossil fuel industry, either calling for a scale back, reduced emissions, or in some areas of the party, a full-on almost abolishment of the fossil fuel industry. But if we look at this chart here on the left, really from March, the energy industry has been one of the strongest performers in the market. But we're still in a very low oil price environment. Exploration is at historic lows, and with potential Biden victory, this could already be anticipated in the price, and it's creating a potentially favorable risk reward scenario. As much as we want to move away from fossil fuels, it's an industry that certainly isn't going away in the next couple of years, and so there's plenty of potential for upside in the near term. And so, one of our recommendations would be to possibly look towards tilting into those companies that are focused more on renewables. Some of the largest oil players, have really been increasing their expenses, their research and development in the area of renewables. Should the Democrats win, and I think really longer term that could play out. Next. So financial stocks. So these have really been lagging the market for some time now. Banks, insurance companies, and asset managers tend to do well in Republican administrations, just given the decreased regulatory environments associated with that. But we would hesitate to rush out of the financial stocks, in anticipation of a Joe Biden victory. Given a few reasons. One, they have already been lagging the market, so some of that could already be priced in. Also, unlike in 2007, 2008, where a lot of the banks were vilified for their part in the financial crisis, their lagging performance has really been interest rate led, and really they're almost viewed in favor, given their role in or their positive role in the stimulus and the payroll protection program, trying to aid small businesses. And one thought is, if we look back, typically Democratic led administrations lead to higher rates, and this could be a big boon for financial stocks. So we think it would be a little bit hasty to rush out of financial stocks, given that they've already been lagging, and there is some potential for growth going forward. One area that is certainly more beneficial under a Republican administration would be the area of consolidations in the financial industry. So that would be one thing to keep an eye on. Next. So infrastructure stocks. So as David had mentioned, typically infrastructure companies, the big construction materials, they've been, there's been a rush into those stocks when Democrats take over the administration and government, based on their propensity to spend more on infrastructure programs. And what we've seen though recently is even President Trump's willingness, desire to spend more on infrastructure as well. There's on the chart on the left here, you see there's certainly a need for a spend on infrastructure, not just our streets and roads, but really across electricity, schools, airports, and as David mentioned, the internet or broadband build out as well. And so while the Dems may have historically been more likely to spend, we think that there seems to be a joint effort or acknowledgement that this is an area where we need to devote some resources. Typically local financing, so your state and local governments have participated in the financing, but it's questionable just how much they're willing or able to spend towards these projects. And so rather than rushing into infrastructure stocks, which have done well, and some of that optimism may already be priced in, it's important to understand which project or which companies are really going to be benefiting from any potential stimulus effort or legislative effort to spend on our country's infrastructure. So in this case, it'd be important to exercise caution and selectivity. And in our view, it's a little bit early to start kind of rushing into the infrastructure stocks at this point. Next. So to sum up, profiting from the elections is certainly very difficult. You have to determine or really have a keen insight and almost in some cases just guess who's going to be winning, not just the presidential election, but as David mentioned, the Senate is up a 50-50 toss-up. So knowing who's going to win, what areas of government is important, but also, knowing what the ultimate agenda is. How much of what we're seeing now is campaign speak, and how much is actually actionable or potentially viable. Once the new administration comes in. Additionally, you need to know, or have an understanding of what could be reflected in the stock prices already, and knowing that governments tend to be more cyclical, just given the 4-year or the 2-year terms. So really, there's nothing wrong with staying the course, focusing long term, and not making any major changes based on what you think may end up being the result of a very difficult election to guess. Which really brings us to the next slide here. So this is a slide that we like to show, and we've shown it before, but we've highlighted in blue in the boxes across the various election years, and you can see which asset classes outperformed in those years. But it also gives you a good idea, if you can kind of look between them, which asset classes continue to outperform during those 4 years. And as you can see, there's nothing that really signifies a consistent winner across the board. And the only area that we see some sort of consistency is right in the middle in that the yellow box, which is the diversified portfolio. So, this kind of goes hand in hand with our recommendation, really to focus long term and understand that there will be volatility, there will be some winners and some losers, but over the long term, staying diversified in your portfolio, tends to outperform it and yield better results.
Hey, thanks, Fritz. So this is the conclusion of the prepared section of our webinar. Obviously, you've got a great shot of our entire team here in the historic Bassett building in beautiful downtown Summit, New Jersey. Come by and visit us when we can all do that safely, of course. And whether it's via Zoom or telephone call or in person when that opportunity is available, we would love to have a complimentary meeting to discuss your finances and investments. At this point, we have gotten several questions, which we appreciate. First question that I'm going to try and field, and I'm going to give the tough ones to Fritz, of course. One question is, what exactly is candidate Biden talking about doing to individual tax rates? And I think the first one, of course, is as part of the Trump tax legislation, the tax rates were reduced. For example, went for top earners 39.6 to 37%. And so I think obviously he wants to reverse that, but really focusing on reversing that, of course, on the people who have the fewest votes, which is the very top earners. And so that's something to look for, is a higher marginal rate on higher earners. Another issue that I think he would like to tackle that's probably near and dear to those of us here in New Jersey, and indeed many of the high tax states, is to remove the cap on the deductibility of state and local taxes. Approximately, it gets complex between if you're an individual, you're filing jointly and so forth. Approximately, you can deduct only about $10,000 of amounts you have to pay for state income tax and indeed property taxes on your home. And of course, $10,000, particularly here in the expensive areas of the country, doesn't go that far. That has chafed, and so we could see that lifting, which could be viewed as a positive, although it certainly wouldn't help the deficit. Capital gains. There's the marginal rates for earned income, but there's rates that are approximately half that when you invest your money, to simplify here, let's say in a stock, and when you sell, the difference, any profit you made, is taxed. If it's been taxed, If it's been held for less than 12 months, it's taxed at about the same rate as your ordinary income. If it's been held long-term, 12 months or more, it's taxed about half the rate. So candidate Biden has talked about that as helping the rich, because wealthier people are more likely to have money to invest as opposed to others. So he's talking about perhaps even getting rid of that special capital gains rate. The problem there, of course, is if you really want to get the economy up in gear for 2020, you're going to need investment. And historically, this country is seen as reducing the tax rate on profits from investment as the best way to get people to invest. So we'll see what happens there. I think the other major area to focus on is estate taxes. Recently, the threshold for the payment of estate taxes on the federal level when you pass away is just over 11 million, and if handled wisely, a couple therefore could get over 22 million down to the next generation. They're talking about reducing that. So from candidate Biden's perspective, the good news is only a few people are going to be subject to that. So you're really just attacking a few who are deemed to be wealthy and therefore not needing that much money. The bad news is it doesn't really raise that much in the way of revenues. The other key thing from an investor's point of view is the so-called step up in basis. Too complex for this webinar, but basically someone who passes away, the next generation takes their stocks and any unrealized gain is forgiven. And they're talking about either when you pass away, the unrealized gain is going to be taxed, or the next generation takes those securities, but that very low basis from when your ancestor bought it carries through, and eventually you have to pay the taxes. So those are some of the things that candidate Biden is talking about doing. Fritz, we've got a natural follow-up question that someone has asked here, which is, of those potential changes, what might actually happen?
Yeah, I think that's certainly a difficult question to answer. I think when you're looking across, the landscape, or really just many different areas of the country, I think most people have an approval for increasing the taxes paid by the wealthiest Americans. I think there's some broad approval for that. But ultimately, though, it does take the two houses of Congress to enact any changes to the tax legislation. So it really would depend on not just what's just campaign speak, but also who's in control of the Senate and House of Reps. And so, most likely, or what potentially to see would be some sort of tax changes to the wealthiest Americans, and whether that's an estate tax exemption going back to what it was previously, because the majority of Americans, they don't hit that, they're not really above that exemption amount. Those are probably more likely than some other, the eliminate the step up in basis that really hasn't been too fleshed out, and not sure kind of who that's going to apply to. So I think those would be the ones more likely to be passed.
Thanks, Fritz. Looks like we've got time for two more. I'm going to take the first one, and then of course the tough one's going to go to Fritz. So the one I'm going to take here is, how, given these potential changes in the tax code, might an investor rearrange their financial affairs? We would first preface our remarks by saying you never want the tax tail to wag the investment dog. So you always want to make sure that whatever moves you make with your savings makes economic sense, is not being done solely to somehow sidestep some taxes. We saw that in the early 80s when people made all these investments in energy drilling, and they got huge deductions, but ultimately the wells were unsuccessful and they lost everything. So you want to be cautious here. Having said that, it always makes good sense to try and move as much of your assets and savings off the tax grid as possible. So how, in regular speak, what am I talking about? That means if you have a 401k at work or a 403b, max out how much you're putting in there. Why? Because amounts that are, once they're in those accounts, will continue to grow on a tax sheltered basis, and that makes even more sense. There also are Roth IRAs. Roth IRAs do regular IRAs, 401ks, and 403s one better. Not only does the money grow tax sheltered, but it can be withdrawn tax free. So the beauty of these accounts is under current law, no matter where the tax rates might be, you're going to escape them, at least during the life of the account, with traditional IRAs and forever with a Roth. So that makes sense too. Now, you can get into more sophisticated stuff. If you knew for a fact that the capital gains rate was going to double, maybe you would take some gains in 2020 as opposed to 2021. But of course, it's always tricky because that means you're going to be paying the tax person a year earlier. And what happens if, in fact, those higher rates don't materialize in 2021, or you're able to offset those gains with, heaven forbid, a loser? So we'd be cautious about getting too radical, but certainly putting more money in tax sheltered accounts is a time-tested approach that will work no matter who gets elected. Time for one more. Fritz, are you ready here? We've got the health crisis. What might that do to any other major legislative changes that might be coming down the pike or considered?
Yeah. So I'd say, while COVID has its grip on the economy and the markets, I think the focus of whomever is in office should be, and it seems to be, ensuring the safety and health of all the American people and the rebound of the U.S. economy. I think, rather than seeing large sweeping changes to the tax code or changes to, the regulatory landscape of the industries in our country, I think that there seems to be this joint consensus that, we're going to try to get us through, the coronavirus that we're seeing here. Both parties, though, have indicated a willingness to spend on infrastructure in a way to help get people back to work and maybe even to take advantage of the low interest rates. But beyond that, I think we envision more the immediate goals, regardless of who's in office, to focus on getting the U.S. The U.S. citizen through this health crisis, back to work, and generally back to more prosperous times.
Good. Thank you, Fritz. So that about wraps it up. But of course, we thank you for casting your ballot in our own election today here. The question, of course, was, who do you think is going to win the 2020 presidential election? No surprise, 57% of you chose Vice President Biden as most likely to win. Only 24% thought that President Trump would return for a second term. And probably the smartest responses were 19% of you who said it's a toss-up, because we do have 100 more days almost, and anything can happen, as we know from past history. So with that, I want to thank you for listening into our webinar. Remember, if you'd like a copy of the slides, just let us know. If we can be helpful, just let us know. And have a great afternoon. Thank you very much. Stay healthy. Bye-bye.